Google shares are slipping in the after hours after reporting their Q4 results. I'm seeing shares down as much as 7.5%. We'll look to, of course, answer the question, can you buy this dip in shares of Google? We'll put things into perspective as it relates to their Q4 results, which again came out after the bell. We'll take a look also at what the upcoming quarters are really expected to look like over at Google. We also got a very, very important CapEx figure for 2025, what this company plans to spend, and spoiler alert, it is a gigantic number. We'll see what that means for companies like Nvidia, companies like Broadcom also, which have a partnership with Google in creating custom silicon, and then we'll try to connect the dots on what it means for other semiconductor names, maybe like TSM or ASML. We'll take a look at the different segments over at Google. Of course, you have the platform you're watching this video on, YouTube, which has been doing really well as you see revenues continue to rise there. You also got further acceleration in Google Cloud growth, and now revenues on that segment actually surpassing revenues out of YouTube. Google Cloud also becoming a very profitable business. We'll dive into that. We also have to answer the question, what is Google going to do with nearly $100 billion sitting on their balance sheet? Certainly it's earning them some money, but as interest rates continue to fall, well, they can probably get a better use for that capital. We'll look to answer that question, and then we'll of course take a look at the technicals. You're seeing shares trade down in the after hour. We'll answer some questions maybe where you can step in from a technical perspective. Hey guys, hope you're doing well out there. If you haven't, hit the like and subscribe button below. We just crossed 2,000 subscribers here on the channel, so want to thank you guys for that. If you're still not subscribed, hit that subscribe button below. It is free, means a lot to me. Now, shares of Google in the after hours, again, sliding despite being up close to 2.5% on the day. You're also up nearly 40% over the past 1 year. So you've outperformed shares on Google, especially outperforming names like the S&P 500. Now, keep in mind, you were coming into this print at all-time highs. I mean, it closed at $207 a share. Your all-time high is sitting at $208 a share. So certainly expectations were hot coming into this quarter. I think a lot of that was due to the fact that you had Meta report last week, some tremendously strong advertising figures, and so some of that bleeds into the expectations for Google to also have a very strong quarter. Now, from a forward earnings multiple, you aren't actually overly expensive on Google, right around 24, probably 23 times, considering this is still looking at 2024 and we're now entering 2025. You also get a nearly 0.4% yield with shares of Google. Not something crazy, but something you can probably continue to expect. Now, revenues in the most recent quarter came in with a rare miss of $170 million. That was still growth of nearly 12% year over year with a revenue figure of $96.5 billion. Now, the reason I said it's a rare miss is because over the past, call it 16 quarters, Google has actually only missed on the revenue expectations 3 times, and their last miss was back in Q4 of 2022, so nearly 2 years ago. And so the reason it's a rare miss is because it doesn't tend to happen a lot. And in fact, Google, when they report their results, they tend to beat revenue expectations by a pretty wide margin. I mean, previously in Q3, they beat expectations by nearly $2 billion. Before that, nearly $500 million, another $2 billion beat, and so on. So you get kind of the picture that Google tends to actually beat on their revenues, those revenues coming in a bit lighter than at least what Wall Street anticipated, coming in with a headline miss. Now, they also came in with a beat on the EPS side, although it's a pretty small beat, roughly 2 cents. I would actually call that more so in line. So Google's headline numbers actually coming in slightly underneath what Wall Street anticipated. Now, the important thing though is to look ahead over at Google, especially for the upcoming Q1. This company tends to not provide forward-looking guidance, and you sort of have to rely on analyst expectations to paint a picture ahead for at least the revenues and earnings over at Google. Now, Q1 revenues are expected to be roughly 89.8. You can round it up to probably $90 billion at the midpoint. That would represent roughly 11.5% growth in the Q1. Now, of course, sequentially, you are seeing a slowdown in the revenues from 96 down to, call it, $90 billion. I mean, it is a Q4 that we were looking at just now, and so you should expect that sequential slowdown. You see this with companies like Meta, like Amazon, pretty much every company out there. Q4 tends to be, of course, the biggest quarter of the year. Now, considering this company came in with a revenue in line to a slight miss, you can probably anticipate Google not being able to come in near the high end of Wall Street estimates, close to $91.5 billion. I'm guessing this number will likely come in closer to probably $90 billion, and so you'll have a tightening up of the estimates over at Google for the upcoming quarter, also maybe for the upcoming year. But again, the miss over at Google wasn't anything huge. In fact, it was probably more so in line, if anything. It's just we tend to expect this company to beat on those revenue expectations. In terms of earnings for the upcoming full year, you can call it, the earnings definitely are expected to slow down. They were putting up massive growth rates in 2024. I think a lot of those efficiencies, at least on the headcount side, have been realized. You will still see them growing pretty decently in the Q2 with expectations from roughly 15% growth. And then of course in the Q4 of next year, you're expected to still see very fast growth, considering Q4 tends to be the quarter where they generate a lot of those bottom line profits. Now, of course, the important thing we do get from Google is the CapEx guidance for 2025. Look, we got this with Meta, with Microsoft. In fact, Microsoft announced nearly $80 billion for their fiscal 2025. Google is planning to spend $75 billion in CapEx in fiscal 2025. So pretty much in line with Microsoft, and that is a huge number. In fact, to put things in perspective, we'll jump down to the cash flows just for a quick second to show you how much Google spent in 2023 on CapEx. That was $32 billion. In 2024, they spent $52.5 billion. And now they're saying in 2025, they plan to spend nearly $75 billion. You're actually seeing an acceleration year over year by roughly $25 billion on that CapEx spend from Google. Now, that you could say is a good thing, considering the fact this company is generating huge amounts of free cash flow, huge amounts of operating cash flow. They are also sitting on huge amounts of cash on their balance sheet, so they certainly have the room to spend. In fact, they could probably spend $100 billion if they really wanted to, and so $75 billion is probably conservative on their end. But what this means for companies like Nvidia, companies like TSM, companies like ASML, who have continually told us that the expectations for their 2025 should be really good, is that those companies will continue to dominate. Nvidia will certainly continue to make a lot of money. They're certainly getting a lot of this business from Google. Now, I think the biggest beneficiary from a semiconductor chain for Google is actually Broadcom instead of Nvidia, because Google certainly is developing their in-house TPUs in partnership with Broadcom. And so Google going down the route of custom silicon more so, but certainly I'm sure they're still heavily invested in Nvidia's H100s and getting those leading Blackwell GPUs later in this year. And so look, if there's any fear around Nvidia, around Broadcom, TSM, ASML, you can probably throw in some other names in there as well, maybe even an AMD. Look, this should really assuage you from those fears. You heard Microsoft planning to spend nearly $80 billion. Google is now saying they're planning to spend $75 billion. Meta had a figure close to $60 billion. And so look, these companies are telling you they're still here to spend a lot of money on CapEx. They certainly don't want to get left behind on the AI build out, especially the hardware build out still is going through its phases, and you're not over that quite yet. You're also seeing this company realize benefits from AI overviews, also circle to search. They're also seeing AI momentum across the business, not just on their core product portfolio, but also internally. They're saying they're seeing building, testing, and launching of products and models faster than ever, making significant progress in compute and driving efficiencies. So look, those are some data points that you can certainly take to the semiconductor stocks out there and draw the conclusions that the spending from these hyperscalers isn't being pulled back in 2025, despite the fears you hear from DeepSeek and so on through mainstream media. Now, the other thing I want to point out on this slide is you have operating margins go from 27% up to 32% in the most recent quarter, also for the full year. So this company realizing a lot of those efficiencies throughout the year, also continuing to maintain them, those operating margins continue to expand, certainly a good thing and something we like to see. Now, from their different segments, you have Google Search, of course, the bread and butter over at this company, went from 48 up to $54 billion. You had YouTube, which is the platform you're seeing this on, go from 9.2 up to 10.5 billion dollars. So strong growth on both the search and YouTube ads business, roughly 12.5, 13% growth on each of those. You did see weakness, however, in the Google network side, as you had revenues go from 8.3 down to $8 billion on that segment. All things considered, though, advertising revenues continuing to hum along from 65.5 up to $72 billion. You also have the all-important Google Cloud business with revenues going from $9.2 billion up to nearly $12 billion. That is 30% growth year over year. Now, that did come in slightly underneath the growth rates we saw from Azure, which were at 31%. Also, I think the expectations from Wall Street was closer to 33% on the cloud business. So certainly the cloud business underperforming the expectations, but look, 30% growth still very, very solid from the cloud business. The other important thing from the cloud business, though, is the fact that you have operating income beginning to explode there. You saw operating incomes now at $2.1 billion last year. you were south of $900 million. So you've more than doubled your operating income on the Google Cloud business, and that is the start of a growing, very profitable segment over at Google. In the past, this used to drag on your operating margins, operating income. Now it's adding meaningful amounts to the operating income side. You also have the other bet segment. You saw revenues actually taper off down year over year on that segment, and then you have some hedging gains over at Google, pretty much meaningless in this quarter. But all things considered, look, you're generating huge amounts of operating income from your core search, YouTube, and services segment at nearly $32.8 billion. Now Google Cloud contributing significantly to the operating income side at $2 billion. You are losing money on the other bets, which tends to always sort of be Google's loss leader. They tend to explore and spend a lot of money on this segment. And maybe sometimes you see new products come out of here, and then you also have Alphabet level activities, which pretty much is just corporate and some things related to employee severance. But look, all things considered, you have revenues of $96.5 billion. And of course, the vast majority of your operating income coming from that core search business. Now, moving on to the balance sheet, this is pretty much as good as it gets over on Wall Street. They have a pristine balance sheet. In fact, probably one of the best balance sheets out of the Mag 7. Certainly Microsoft used to have a pretty good balance sheet. They completed that huge acquisition of Activision, and now they have some debt. But over at Google, you're still sitting on nearly $100 billion of total cash and cash equivalents. You also have this property, plant, and equipment line continuing to skyrocket from 134 now at $171 billion. Tells you the spend this company has been doing in building out those data centers, really trying to keep up with demand for Google Cloud. In terms of liabilities, you don't have a lot of debt. In fact, your debt went down year over year from 11.8 down to 10.8. You could also say this accrued revenue share, which is pretty much paying out creators here on YouTube, sitting at $9.8 billion, that you could count that as sort of debt, because that is something Google will have to pay out eventually. But look, you're seeing that number actually rise year over year, which is a good sign. You actually, as an investor, want to see this number rise. It tells you that YouTube ads are certainly doing well. Content creators are choosing to spend their time creating content here for YouTube, and the ad rates they're getting on that is certainly good. So if content creators are making more here on YouTube, certainly you could paint the picture that YouTube itself and Google itself are making a ton. So look, I mean, you have nearly $100 billion in total cash over at Google, not a lot of liabilities. So in the new Trump administration, will this company be able to go out there and complete more acquisitions? Or will the anti-monopoly and anti-competitive sort of headlines over at Google continue to weigh the amount of acquisitions this company can do? Google is probably one of the few companies that can actually go out and pick up a company like TikTok pretty easily. They certainly have the cash and the equity on their balance sheet to do that. Now, certainly regulators won't allow TikTok to land in Google's hands, considering they're already considered anti-competitive on that search side. But look, if Google can go out and complete more acquisitions, then certainly they could look to maybe accelerate growth on that search and advertising business. They're of course also still spending huge amounts of money on Waymo, and look, if that pans out in the future as a dominant threat and a dominant competitor to autonomous vehicles, to Tesla's self-driving technology, then yeah, that spend on Waymo certainly could be valuable. Now, from a statement of income perspective, we'll take a look at the year ended December 31st, basically the full past year. You saw revenues now sitting at $350 billion for the full year. And look, your cost of revenues tend to relatively climb in tandem with your revenues. This is your traffic acquisition costs, and so those tend to scale relatively in line. You also had R&D grow from $45.5 billion up to $49 billion, so relatively decent growth on R&D. But the sales and marketing is very impressive. You went from 27.9 down to $27.8 billion for the full year on sales and marketing expense, and then G&A actually went down from 16.4 down nearly $2.5 billion to $14.2 billion. Look, just $16.4 billion in G&A cost for $300 billion in revenue last year. That was phenomenal. This year, they got even better, bringing down those G&A costs while continuing to grow revenues at a very, very solid clip. So the efficiency over at Google is certainly being recognized, especially from a sales and marketing and G&A perspective, that is meaningfully adding to their operating income. You're seeing even net income climb rapidly as you went from 73.8 now sitting at $100 billion in annual net income for 2024. So, I mean, that's pretty easy math to do. You have $100 billion in net income. You have a $2.5 trillion market cap. You do a earnings multiple on that, and you get to 25 times an earnings multiple. So look, even at a trailing basis, certainly Google isn't expensive. And when you look ahead, if you expect earnings to grow relatively 10, maybe 12% in 2025, yeah, that forward valuation certainly isn't looking overly expensive either. Now, from a cash flow perspective, you got that $100 billion in net income for the full year. That translates into nearly $126 billion in operating cash flows for the full year. And like we discussed, $52 billion in CapEx. In fact, for the most recent quarter, they spent nearly $14 billion in CapEx, which was an acceleration year over year, as last year you spent nearly $11 billion on your CapEx. And so Google is seeing that acceleration in CapEx. They also just told us they plan to spend nearly $75 billion in full year CapEx for 2025. So you can expect that continued acceleration, maybe even some quarters of $20 billion in CapEx spend coming in 2025. But despite that, this company's still printing nearly $25 billion of free cash flow in the most recent quarter. And what do they do with that? Well, they pick up some marketable securities, some non-marketable securities as well. And then mainly they tend to do a huge buyback to the tune of $15.5 billion. They also now pay out a dividend of roughly $2.5 billion, which I anticipate them to continue to increase sometime in 2025. And then, well, they just continue to add cash onto their balance sheet. So this company continues, despite spending more and more on CapEx, still being very, very free cash flow positive, to the point where they just simply don't know what to do with that cash. They continue to bolster on their balance sheet, which is already phenomenal. I think this company needs to go out there, do some acquisitions, certainly if they can. From a regulatory perspective, this is one of the few companies out there with a fortress balance sheet that, as the interest rates begin to lower and they can probably generate less and less income on that cash on their balance sheet, an acquisition makes more and more sense. Now, from a technical perspective, you're seeing shares down to $190 in the after hours, down roughly 8%. In my opinion, this is probably an overreaction if it's simply due to the fact that you had a headline revenue miss. Look, that revenue miss isn't huge. In fact, it's pretty much in line. Also, your growth rates on the search and advertising staying pretty consistent. Your Google Cloud is still growing at 30%, even if it might come slightly underneath what Wall Street anticipated. So in my opinion, I think this is a pretty clear buy the dip opportunity. You've been trading in a well-defined uptrend over at Google, making higher highs and higher lows. So certainly you were coming into this print at all-time highs. You had a chance to maybe come up here, retest the top end of the range. That's kind of what we saw from Meta. It was also set up near at all-time highs, and it posted some solid results set up near the top end of the range. With Google, we're seeing shares trade off and slip, but look, you're still in a pretty well-defined downtrend. In fact, you can come all the way down to the 180s, depending on how fast you do it, and this company would still be in a well-defined uptrend where you're continuing to buy the dip. So your first level to buy the dip is actually probably down here at 180s. If you want to be a bit more aggressive, if you already own shares of Google, you want to continue dollar cost averaging, certainly wouldn't blame anyone for stepping here at 190. In fact, if shares continue to move lower, maybe in the after hours, maybe early tomorrow, I'll probably continue to add into shares of Google, as this company is a well-oiled machine. They have a lot of cash on their balance sheet. You do have some regulatory overhang with, of course, their Chrome browser and AI search like ChatGPT possibly eating into their business. But I think what we saw from their core results, at least on the search and advertising side, is they're continuing to do just fine with their bread and butter advertising. They're also introducing AI into different parts of their applications, and well, that's proving to be successful over at Google. Let me know your thoughts on this one in the comment section below. I think this is a pretty big overreaction to a decent, I wouldn't say stellar earnings, but pretty decent earnings. And I think when you got that CapEx figure for $75 billion for 2025, I think that paints a really good picture for NVIDIA, probably also a better picture though for Broadcom. And so you can begin to connect the dots as it pertains to that. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.